Welcome to the Investing Mastermind Podcast. My name is Sina Lundholt.
And I'm Michelle Markey.
Today we wanted to talk about why now is the perfect time to learn about investing in companies and investing the way Warren Buffett invests. And you might wonder, well, how come now is a great time to invest? Because the stock market has been going down for a while, and maybe you feel like you want to sell your shares, but right now is actually a good time to invest in stocks, right, Michelle?
Yes, absolutely. And I've been buying a little bit here and there. And, part of me is eager to potentially see some of my favorite companies be even more on sale than they are right now. So even though I've started buying a little bit, I'm hoping that we'll have an even better buying opportunity. Just like when I go to the grocery store and I see that some of my favorite things that I like to buy are super on sale, like 50% off or more, I get way excited and then buy up a lot so that I have plenty in stock. And then that's the same framework I use with investing as well.
Yeah, exactly. And, even though that some, like you mentioned, we really want to buy quality companies at a sale, but on the stock market, quality is not necessarily equal to something expensive. So just because a stock is super expensive and cost thousands of dollars doesn't mean that you're actually dealing with a quality company. Oftentimes in the real world, outside the stock market, when you buy something of a great quality, like a leather wallet, and if you want quality, it's oftentimes more expensive than when you buy a fabric wallet that looks like leather. That one is usually cheaper, but in the stock market, just because something is more expensive doesn't mean that it's quality. What Warren Buffett says is that price is what you pay, value is what you get. So when we talk about quality companies, we don't talk about expensive stock. We talk about businesses that has a moat and management with integrity, something that we've talked about in a previous podcast. So go back and listen to that. There's talk that we're currently in a recession and we don't know if we're going to see a downward spiral. But what we can say is that actually Michelle and I are hoping that stock prices will go even more down, right?
Yeah. And actually, I wanted to riff on what you mentioned about how just because a stock seems expensive in the market, like you've probably seen stocks that are trading for $1,000 or more, and that seems like a lot of money. But you have to actually look at a company from its overall market cap of what is its total value in the entire stock market. Like, for example, Apple used to be a $3 trillion company, and then it's recently gone down to below $2 trillion of a market cap. And then eventually you break that down into looking at the outstanding shares, and then you identify the per share price. And even though it might seem like a lot or little, you have to use certain valuation calculations to figure out, is this a good price? Because just because you might be seeing some sticker shock because it seems high, or compared to its all-time high, a stock might seem high, but there's actually other ways that we'll talk about in the future about how you figure out what is a good price to pay for any given company in the stock market. So yeah, I just wanted to put that out there because a lot of people actually make that mistake of, once upon a time, Amazon was trading at $2,000, and that seems like a lot of money, but maybe if people did a valuation calculation, they might see that actually $2,000 is a great price because the value might be $4,000. So that's just a hypothetical example. I'm not endorsing Amazon or saying what is a good price for Amazon. And they also had a stock split. So they're no longer having their shares trade at $2,000 a share. But some people think that just because it's at $2,000 per share, they think that that's expensive, but it's really not necessarily. So there's way more to evaluating stocks than just what you might see being offered to you on the stock market. And it's definitely not the same. Like if you see a very expensive multi-thousand-dollar handbag, it's not the same thing of like you're able to just assess the value of this handbag based on its price compared to other handbag. It's a little bit different than that comparison.
Yeah, you need to look into the business and find out if you're buying quality. I also wanted to talk about that it might actually be very difficult to buy right now, especially if you've bought stocks in the past and now you're seeing that they're going down every time you open your Robinhood app. Maybe you see a few percentage points down every time you open the app. So I do definitely understand why it could be super difficult to actually invest right now. But something that I personally use and I find super valuable is a checklist. And a checklist, I mentioned it in a recent podcast as well. You just want to make sure to have a few things that you always check before you buying a company, because once you run through your checklist, you can make absolutely sure that everything is living up to your standards when buying a company. I have a checklist, and maybe we can link to that in the show notes that you're welcome to use before I invest in stocks. That will just give you some certainty before you start investing. Do you use a checklist?
Yeah, I've gathered some criteria that I generally like to go through before I were to invest. And some of these go back to the four principles from Charlie Munger and Warren Buffett that we talked about in the previous episode. So I try to get to know those factors of management and do I care about this company? Like, what does it do? What does it offer? What might be some of the risks with investing in this particular company? What is the impact it has on society and on me as maybe a consumer of the company's products? Or there are so many questions to also ask just on what does this company mean to me kind of level, as well as the more quantitative factors like the return on invested capital, which is a more specific metric to evaluate if you're trying to see if this company is relatively profitable or not, as well as other things like, is it available on the market at a price that makes sense to me that I would be willing to pay, or do I think the price is still too high and I'll wait until maybe it comes down a little bit? So those were some of my criteria that I have on a like informal checklist, if you will. And I was wondering, how do you use your checklist and what are some of the things on it?
Yeah, so for me, I actually have several checklists. I love checklists. So I have a start checklist to just make sure that the company has a profit and increasing sales growth. I definitely don't want to invest in a company that comes out with a loss. So I definitely want to make sure that the company has a profit. I'm also looking into the debt of the business, because if it's got a lot of debt, then I just stop right there. I don't even want to continue. So I have this start checklist that I always start out with, making sure that it's got increasing sales, increasing revenue. That's a fancy word for sales, and not declining sales over a longer period. And those numbers are available through the 10K, the annual report, but also numbers that you can find on the internet, like, for example, on Yahoo Finance. You can search for the name of the company there and check the financials there. And it just literally takes, 2 minutes to check these couple of numbers. That's on my first checklist. And then my next step is a much longer checklist with a lot of checks on. And that's the one we can link to in the show notes, which is a great checklist also for beginner investors to just get started on a checklist. And you can always add your own questions over time. I've done that. Like, for example, in the very beginning, when I was a new investor, I had a checklist and I invested in a company, but it actually had declining sales growth. And I forgot to check about that. So I added that to my checklist because as a new investor back then, I just forgot to to look at that. And so now that's a part of my checklist.
That's great.
Um,
And
yeah,
some also financial data you can find that I think would be helpful where it might appear on your checklist. Things like if you want to see the sales growth going up over a period of time, like at least 5 to 10 years, you could go to something also like gurufocus.com. Like I go there sometimes and I see, even though they, don't reveal all the data, but you can see some of the trends, like for example, the earnings per share growth trends and the sales growth trends. And that might give you a very high level idea. It's not the only criteria, but I just thought that that is also another way to check off some of those items on the checklist you were talking about.
absolutely. That's actually great that you mentioned that, because I'm also a very visual person myself. I like to see the graphs and see those visualizations. So yeah, Guru Focus is a great resource for visualizing some of that data in some infographics. So yeah, that's a really, really good point. What's really important to mention here that is that Michelle and I, we're also investing for the long term. We're long-term investors. We actually talked a little bit about it's, Warren Buffett, he likes to keep his companies forever. Phil Town sells once the stock reaches its intrinsic value price, or once the stock is overpriced. So we all have our own time horizon. Mine is 20 years or longer. I really want to invest in companies for the very, very long term. Do you have a set time, or are you more, going with the flow?
Well, yeah, I mean, I also would like to invest for the long term, and I think that there's some differences in how all investors kind of approach the goal, and I think we have a lot in common of we want to try to hopefully get pretty decent returns, and sometimes if you invest for longer periods of time, you're more likely to reach significant returns. For example, there's been some studies that, let's say you were invested in a stock for 26 years, you might have a higher chance of realizing that the stock could have reached 100 times what you bought it at. And, you might think like 26 years is a long time to invest. But if you also think about 100 times what you initially invested, that's incredible, and could mean the difference between, if you had started out investing only $10,000 in a stock and you waited and held on to it and it was a great company after 26 years and then it became $1 million just from that small initial investment, that would be so amazing, right? So ideally, many of us should want to stay in something for as long as we think we can hold it, because that's the ideal that Warren Buffett has set. But then there's also merit to what Phil Town has done, as what he talked about in the Invested podcast with his daughter Danielle, and that sometimes, I've heard them talk about Chipotle, and that, he bought it at a pretty good price and it doubled and he was like, okay, it's time to sell it. And then it went on to, become 6 or 8 times what he initially invested in. And he sounded like he wishes he would have maybe held on or sold it later, but maybe he thought that if he sold out, he could reallocate the money somewhere else because it doubled so quickly in a relatively short amount of time, where it was definitely less than 2 or 3 years in which it doubled. So sometimes when you have situations like that and you feel like the stock already reached its intrinsic value, maybe it is time to sell and then reallocate that to something else. And then let's say Chipotle were to go back down, maybe Philtown will invest in it again when it comes back down. And then, it sort of repeats the cycle. But I think that that's, there's no right or wrong. It's just what we're comfortable with. And so, if it helps give us peace of mind that we sort of set and forget it, like something when Buffett invested in Coca-Cola, and initially, I think in 1988, he only kept adding to it. I don't know if he ever sold any part of it, but for the most part, he's basically just held on to it. So there's also something nice about just setting it and forgetting it, just having the trust and conviction that this company is going to still be great in the future, and you believe in it and you trust that it will still be profitable, which has worked out for Berkshire Hathaway. Like they still have owned Coca-Cola for 34, almost 35 years, and that's pretty great for them. So I think that whichever approach we take, it just has to be one that we're ultimately comfortable with our own investing temperament, because that will differ for everybody, our comfort zone. So I try to, hopefully try to hold on to my company stocks for as long as humanly possible. That's the ideal I'm going with. Like I'm going with the mindset of what Warren Buffett said of, you shouldn't own a stock for 10 minutes if you're not willing to own it for 10 years. So I kind of try to put that benchmark of, I plan to hold this for at least the next 10 years. That's what I usually aim for.
Yeah, and I actually, talking about Phil Town, I just thought about one of the first investments I made using the value investing technique. I actually sold when the stock reached like a ridiculous price. I was like, okay, I'm going to exit now, just like Phil Town would have done. And then I sold the shares, but then the whole market was overpriced. And this stock, it just kept going up, and I couldn't buy anything because there was nothing that I could find that was within my circle of competence, et cetera, et cetera. So I was just sitting in cash. So actually, to that point there, I've definitely learned to keep it instead of selling. And then there's nothing new to buy. So that was also another reason to just hang on. So in general, don't sell a wonderful business if it's, on your checklist, if it's still wonderful and it just still checks all the marks in 20 years, don't sell it. If it's a bad business, well, I'm not a financial advisor, but maybe you want to sell. It's difficult. It depends. It's individual. But since this is the Investing Mastermind podcast, I also wanted to name drop a few names that's done really well at a time like this. So we have John Keynes, the famous economist, and Ben Graham, that's done incredibly well in recessions after they applied this kind of investing strategy, because they used to actually do something different. We also have Warren Buffett. There is, what's his name? John Templeton. That's also done extraordinary in a recession. So yeah, that's just a few names of these investor mastermind. And what you can do is you can model what they do by following their strategy and understand this strategy, which is really the antidote to panicking when the market is down. And also what really helps in getting that confidence is to look into your checklist, which is your research paper that will really give you the confidence when the market is down like this.
Right. And also, if you're wondering which kinds of companies should I invest in right now, because maybe you're happy to invest and have the money to invest, and you're wondering, what should I be even investing in? And some of this you might already know from your own experience of, like, there are certain companies you like you use their products and you just like the services you get from those companies. Those might be ones that you can look into. And another is, if to Sina's point, is to look at what these really great investors are currently invested in, maybe, or what they are newly starting to invest in. Like, we can see the stock holdings of Berkshire Hathaway on sites like Dataroma or Whale Wisdom. And by looking at that, that might give you some ideas, not to say that you just blindly copy what Warren Buffett or his investment managers have invested in Berkshire Hathaway's portfolio, but it might give you a clue of, these are really good companies that these really great investors already vetted somehow, and they seem to believe in it. So that could add to your checklist of researching companies to see, is it within your ability to understand them as well? And then if it is, then maybe you might want to invest in them. Like, I'm currently starting to do that with semiconductors, and I didn't know much about them. Like, I know semiconductor parts are in my computer and my phone, in a lot of devices I use all the time, but I didn't know that much about the semiconductor industry. But then when I learned that Warren Buffett's company, Berkshire Hathaway, had invested in Taiwan Semiconductor Manufacturing Company, or TSMC, I was like, maybe I should look into this company and just study it and see if I can understand them, or other semiconductor companies. But that just gave me a clue. And I also became inspired to look more into semiconductors from this other resource called the We Study Markets newsletter, and it's totally free. And it's actually a new offering from the Investors Podcast Network that has the podcast show We Study Billionaires. And they've interviewed some famous billionaires like Ray Dalio and many great investors like Howard Marks and Joel Greenblatt. And I've listened to that podcast for years. And when I recently signed up to their newsletter, We Study Markets, I learned more about the chip wars between the US and China and what impact they're starting to be with the semiconductor companies. So I thought it was really interesting to start learning about that. And it was just so convenient to sign up to that free newsletter that any of us could do that if we want. And we'll include a link to that newsletter in the description of the show notes today. But I just found that really helpful personally. And the insights that I get, it's daily from this newsletter. It's only 4 to 5 minutes of a read. And we don't even have to necessarily read the whole thing if we don't want to, but it's just like a nice extra resource to have of them making some market commentary and also providing insights into what might be happening in the market. So I found that helpful. And I think, Sina, you might have also signed up to that too, right?
Yeah, I was lucky to get it right from the beginning because I was already signed up for the website, and so I started getting it in my inbox, and I was like super excited about it. And so I want to allow everybody to actually go and sign up now. So maybe with that, goodbye for now, and we'll be back next Tuesday.
All right. Till next time, everybody.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.